Welcome to Iron Financial. This is where we forge stronger portfolios by taking a blowtorch to market noise and hammering out the facts. Today, we've got Noodles Company, ticker NDLS, on the anvil. They just dropped their Q4 2025 earnings, and, well, the market went absolutely ballistic. Our job today is to figure out what's really going on. Are they building a solid foundation for real growth, or is this whole thing just a house of cards, ready to get blown over by the slightest breeze? Let's get to work. So first, let's look at the catalyst, the reason we're even talking about this. The day the earnings came out, the stock didn't just go up, it absolutely exploded. We're talking a 23, nearly 24% surge in a single trading day. Now, that kind of euphoria, that kind of market reaction, it absolutely demands a stress test. You know, when the entire crowd gets this excited about something, our job isn't to run in and join the party. No, our job is to get out the tools, inspect the structural integrity of this thing, and see if it can actually handle the pressure. A move this violent needs a serious justification. And that really brings us right to the core question of this whole deep dive. A nearly 24% jump overnight? That's pure market mania. It's a massive bet, right? A bet that this is some kind of bulletproof turnaround story. But our job here at Iron Financial is to pop the hood and see what's really going on with the engine. Is this thing truly rebuilt from the ground up, or did they just slap on a new coat of paint and hope nobody would notice? Is this turnaround actually being forged in the fires of real operational discipline, or is it a carefully set financial trap, baited with some pretty headlines to lure in unsuspecting investors before the floor completely gives out? So here's our blueprint for today. This is how we're going to hammer this thing out. First, we'll dive right into that market mania and the surge itself. Then we're going to construct the bull case. We'll lay out every single piece of steel that supports the argument for growth. We'll show you exactly what has Wall Street so excited. But immediately after that, we're going to take a sledgehammer to it with the bear case, exposing every single flaw. Then we'll scrutinize their game plan for 2026 to see if it actually holds water. And finally, we deliver the Iron Financial verdict. Let's get into it. Okay, let's really dissect this market reaction, because frankly, a 24% pop for a company that has been struggling for as long as this one has, it kind of smells desperate. You have to ask yourself, what could they possibly have said to justify a move that explosive? This wasn't just a slightly better than expected quarter. No, the market is pricing in a fundamental, permanent shift in this company's entire trajectory. It's betting the farm that the absolute worst is over. So our first job is to figure out if that bet is based on hard, cold evidence, or if it's just pure speculative hope. All right, so here they are. These are the headlines that poured gasoline on the fire. And, you know, on the surface, it looks like a perfect storm of positive data. You've got a revenue beat coming in at $122.8 million. You have a really solid 6.6% jump in what we call system-wide comparable sales. That's a key metric. Then you see adjusted EBITDA, which is just a fancy way of looking at profitability, nearly doubling year over year. And then the real kicker, they issued really strong guidance for the upcoming year, for 2026. This combination, a good look in the rearview mirror with a beat and a bright, shiny promise for the future, that is the precise rocket fuel that sends a beaten-down stock like this into orbit. Okay, now let's put on our analyst hats and really build the bull case. I want you to forget the stock price for a minute, just push it aside, and let's focus on the actual business operations, because that is where any real turnaround has to begin. The argument here, the one the bulls are making, is that management isn't just getting lucky. They are actively forging a new, stronger company through disciplined, day-in, day-out execution. So we're going to look at the hard data that suggests this momentum is the real deal, and that it might just be sustainable. This is the heavy lifting of financial analysis. Let's get granular. The headline number for comparable sales was that strong 6.6% we just saw. But the real story, the one that really matters, is this: 7.3% growth at their company-owned stores. Now, this is absolutely crucial. Why? Because it isolates the core part of the business that they directly control. It proves the improvement isn't just some weird fluke coming from their franchise partners. It's a direct signal of stronger consumer demand and much better operational execution right where it counts the most. This right here, this is the first pillar of a solid bull case. And here's where you can see how that strength at the top line flows right down to the bottom line. Look at adjusted EBITDA. It didn't just grow, it leaped 90% to $7.6 million. This isn't a small step forward, it's a giant leap in profitability. And even more importantly, look at that restaurant contribution margin. It expanded by 290 basis points. For anyone not familiar, a basis point is just 1/100%, so we're talking about a 2.9% improvement. That means for every single dollar in sales that comes in the door, they're keeping almost 3 extra cents as profit at the store level. That's huge. And you can see even the net loss narrowed substantially. Every single key profitability metric here is moving aggressively in the right direction. So the big question is, how did they pull this off? Well, it wasn't magic, it was a grind. This slide here breaks down exactly where that margin expansion came from. And you can see they attacked costs from every single angle. The cost of their food and paper goods, that dropped 120 basis points. Their labor costs came down 140 basis points. They were disciplined. They took necessary price increases on the menu. They cut way back on those profit-killing discounts. And they even went back and secured better terms with their vendors. This right here is what real operational execution looks like. It's the blocking and tackling of running a business well, and it shows a management team that has a firm, steady grip on the fundamentals. And this is what the CEO, Joe Christina, had to say about it. He said, "We've built meaningful momentum by focusing on the fundamentals." You know, a lot of the time these CEO quotes are just PR fluff. But this time, the numbers we just walked through back this statement up completely. They are telling a very consistent story. Focus on your core business, get your costs under control, improve the customer experience, and the performance will follow. From a bull's perspective, this is exactly what you want to see. A clear strategy executed with precision leading to tangible, positive results. The foundation looks solid. But that's the operational story. And yeah, it's a good one. The problem is, it's sitting on top of a crumbling financial foundation. That impressive fourth quarter, it's like a fresh coat of paint on a structure that has serious, deep-seated issues. The operational wins are, frankly, a dangerous distraction from a much more perilous balance sheet reality. So now, it's time to expose the cracks in the armor. And trust me, these are not small cracks. These are gaping holes. Let's just start with what might be the single most terrifying slide in this entire presentation. On one side, you have cash on hand, a mere $1.3 million. That's it. That's all they have in the bank. On the other side, you have their total debt, over $110 million. Just let that sink in for a second. This isn't just leverage. This is a company walking a tightrope over the Grand Canyon with no safety net. With only $1.3 million in cash, they have virtually zero room for error. A single bad quarter, an unexpected spike in chicken prices, any little hiccup, and they are in serious, serious trouble. This is a massive structural flaw that undermines every single good thing we just talked about. Now let's zoom out from that one good quarter that has everyone so excited. The bulls, they want you to focus only on Q4's improved net loss. But what happens when we look at the entire year? Well, this chart tells a very different, much darker story. In fiscal 2024, they lost $36 million. Okay, bad. But in fiscal 2025, that loss widened to over $42 million. So while they're out there celebrating a slightly better 3 months, the bigger picture shows that the financial bleeding is actually getting worse, not better. The company is burning more cash on an annual basis. That is a giant red flag, especially when you have almost no cash to begin with. And what about actual growth? You know, for all the talk of sales acceleration and meaningful momentum, the full-year revenue is basically stagnant. It's up a mere 0.4%. Let's just be crystal clear about this. This company is not growing. The whole narrative of a dynamic, growing turnaround completely falls apart when you look at this number. This isn't a growth story. It's a story of a stagnant business being crushed under a mountain of debt. And finally, let's talk about the 1-for-8 reverse stock split they did back in February. Let me tell you something. Healthy, strong, growing companies do not do this. A reverse stock split is a cosmetic trick. It's a financial maneuver designed to artificially boost the share price, usually because the company is trying to meet the minimum price requirements to stay listed on an exchange like the NASDAQ. So the crucial point to understand here is that this is not a sign of strength. It's a defensive move. It's what companies do when they're desperately trying to keep their head above water, not when they're busy building a fortress. Okay, so those are some significant historical risks, and that liquidity situation is frankly alarming. But investors don't trade on the past. They trade on the future. So now we have to turn to management's blueprint for 2026. This is the very plan that the market is betting on so heavily. We need to really dig in and determine if this plan forges real, sustainable growth, or if it's just more financial engineering designed to mask all of those underlying problems we just uncovered. So for 2026, they're guiding for total revenue to be somewhere between $478 and $493 million. Now, notice, the high end of that range is actually slightly below what they did in 2025. But look at the next lines. They are projecting very strong comparable sales growth of 6 to 9% and a really significant jump in adjusted EBITDA to between 30 and 35 million. So what's going on? Well, the core of their strategy is to become much more profitable on slightly lower overall revenue, and they plan to do that primarily by closing 30 to 35 of their underperforming company-owned stores. This entire strategy comes wrapped in this shiny corporate jargon they call portfolio optimization. Oh, it sounds so strategic and proactive, doesn't it? But let's just call it what it really is: shrinkage. This isn't a growth strategy, it's a survival strategy. What they're doing is improving the company's average performance by amputating the worst performing parts. Sure, it makes the remaining body look healthier on paper, but the body itself is getting smaller and fundamentally weaker.
And you know what? You don't even have to take my word for it. Let's just look at what the CFO, Mike Hines, said himself on the earnings call. When he was asked about that projected $10 million improvement in EBITDA for 2026, he stated, and I quote, "A little less than half of that will be due to closures." Just let that sink in. Nearly 50% of their guided profit growth isn't coming from making existing stores better or more efficient, it's coming from simply lopping off the ones that are losing money. That is a critical distinction to understand. It's not growth, it's addition by subtraction.
So this slide breaks down their whole playbook, and this is where the financial engineering becomes absolutely undeniable. Step 1, you close 33 stores. Step 2, you claim a sales transfer, meaning you assume customers from the closed stores go to your other nearby stores, which artificially boosts your comparable sales growth number. Step 3, you just repeat the process, closing another 30 to 35 stores. Step 4, you then forecast an even bigger artificial boost to next year's comp sales from this next round of closures. Let's be blunt here. A huge chunk of their projected growth isn't organic growth at all. It's an accounting illusion created by shutting down failing stores. It makes the core business look far, far stronger than it actually is. So there we have it. We have the bull case, which is built on some pretty impressive operational momentum, and we have the bear case, which is built on a dangerously weak balance sheet and some very questionable financial engineering. We've stress-tested the numbers from both sides. So now it's time for the iron financial verdict. Is this thing an opportunity, or is it a trap?
Let's put it all on the table, side by side. The foundation for the bull case is clear. You've got accelerating comparable sales, really strong margin expansion, those soaring Q4 profits, and a confident outlook for the future. That is a solid operational story. You can't deny it. But the cracks in that foundation are just as clear, and they run deep. Full-year revenue is stagnant. The full-year net loss is actually getting wider. The liquidity situation is nothing short of perilous, and their future growth is being propped up by this artificial boost from closing stores. The foundation might look good from a distance, but the ground underneath it is incredibly shaky.
After weighing all the evidence, after hammering on this from both sides, here is the iron financial verdict. The operational turnaround is real, and it is impressive. Management is absolutely executing at the store level, and they deserve credit for that. But it doesn't matter. The balance sheet is a ticking time bomb. With only $1.3 million in cash against $110 million in debt, they are in a desperate race against time. They need flawless, perfect execution from here on out just to generate enough cash to pay the interest on their debt, let alone ever pay it down. Any operational slip-up, any change in the economy, any unexpected event could be fatal. This is not an investment for a strong, sturdy portfolio. This is a high-stakes gamble on a management team trying to defuse a bomb while running a marathon. And that leaves us with the one ultimate question you need to ask yourself before even thinking about this stock. Management is trying its best to forge a foundation of profitability, one painful brick at a time. But the crushing, heavy weight of their debt threatens to shatter that foundation before the mortar has even had a chance to set. So, can they build faster than the debt clock is ticking? The answer to that question will determine whether this becomes a legendary turnaround story or just another collapse. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.